presentation contains current opinions of Moe Sansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compact YouTube update for December the 1st, 2025. I'm Mo Ansari, President of Compact Asset Management, and thank you for joining me today. Again, if you want the whole podcast, a longer version of this YouTube update, you can go to compact.com, click on Insights, and you can hear the entire podcast with Javed and I, where we go into a lot more detail. But you can see the charts right here, and you can look at all of this at your own convenience. All you have to do is click on the subscribe button also, so whenever I post a new update on YouTube, you will be notified and you can watch it at your convenience. Again, don't forget, if you like to get help on your portfolio, get a second opinion on your portfolio, all you have to do is send us an email at invest@compact.com or give us a call at 800-388-9700, and I will be more than happy to get back with you, set up an appointment, and go through your portfolio so you are ready for the new year. Looking at the markets, a wonderful week last week in the markets. S&P was up 3.74%, a nice bounce back after the little Dow was up 3.2%. NASDAQ was up 4.91%. For the year now, the S&P is up nearly 18%. We're looking at the NASDAQ up nearly 22%. So it's been a wonderful, wonderful year overall. And when you look at the last 3 years, combining 25, 23, 24, 25, I mean, we have had a tremendous rally. NASDAQ has nearly doubled in the last 3-year period. So we've had a good run. Market was getting a little bit nervous last week. I think everybody is waiting to see what the Fed is going to do. Expectation is the Fed is going to cut interest rates by 25 basis points at their next meeting, which they will announce on Wednesday. But also there's a lot of news that the president is going to announce a new Fed chair by the end of this year, which will sort of make Jerome Powell, where his term does not expire until May, basically make him a lame duck chair. And it'll put pressure on the Fed to lower interest rates. What does that mean? Well, when the rates go down, that's good for the stock market. But even with all of this expectation that we're going to get a new Fed chair, that we're going to get an interest rate cut, rates were up sharply today. So the bond vigilantes are saying, wait a minute, you just can't cut interest rates. If you do, we are going to push interest rates up instead of down. The market is what sets the interest rates on the 10-year bond, which is basically used for all the financial calculations. Even though the Fed might cut rates, bring the prime rate down, it makes not a big difference for the stock market. So what you really have to watch is the bond market, the 10-year yield on the bond market. And today it was up, and that put some pressure on the market. Communication services was the best sector last week. That is basically Google and Meta. Google is having a wonderful month so far. Last couple of weeks have been great since they announced Gemini, which is their new AI part of their holding. And they said the Gemini AI is better than ChatGPT, and it could take quite a bit of market share from ChatGPT. We'll have to wait and see if that happens or not. But Google is looking good, and that's why we saw the big jump in the communication services sector. Every single sector was up last week. Even energy was up 1%. Even though crude oil prices continue to drift lower, they're at about 58.5, and that is should have put some pressure on the energy sector, but it has done well overall. Interest rates last week dropped down from 4.6 to 4.2, just hovering right around 4. But today we see a big jump to about 4.10, which was a big move up in rates. Durable goods, when you look at the content of amount of goods, basically that is 38% of appliances. New vehicles are the two that could be really affected. How much value is by the tariffs? Because how much value, 38% of value is added for appliances, 31% for automobiles, and we keep going down and down from there. But those two sectors are the most vulnerable to tariffs, and we'll have to wait and see. Looking at the economic data, we saw retail sales, they're sort of holding up. They were up 0.2%, and year over year, they're up 4.3%. But consumer confidence continues to come down. We saw it down from 95.5 to 88.7. And that is something that we need to think about. Because right now, the middle class is really getting squeezed, and the baby boomers, they are spending. But if the stock market gets wobbly, because that's where a lot of the wealth has been created, especially for the baby boomers, they might pull back. And that could have a ripple effect throughout the economy. Middle class is already squeezed. The lower class is already squeezed. The spending right now is done by basically the baby boomers and people who are in the stock market and in the real estate market who have assets. But if assets start to get a little wobbly, I think that's where we could see a cutback in spending. If you see a cutback in spending by the baby boomers or the upper class, that will ripple throughout the economy, and something that we have to watch very carefully. Today we got ISM data. It came in lower than expected. Consensus was 49. We got a reading of 48.2. That means that the economy is the ISM index, which is Institute for Supply Management, the durable goods, manufacturing is sort of chugging along. We get a big data point at the end of this week. We get the PCE. That's the Personal Consumption Expenditures Index. It's an inflation gauge, and that's what the Fed pays attention to. Everybody looks at the CPI and the PPI, but the PCE is what the Fed looks at. And if that comes in a little bit lower, I think it'll give us a little bit of boost and solidify the expectations of a lower interest rate cut next week by the Fed. Looking at the technicals, we've completed wave 3 to the upside. I was expecting wave 4 to the downside. Looks like we've completed wave 4, and now we're starting wave 5 to the upside. What does the projection show? It shows from this high that we made, wave 3, we get a fifth wave projection, which comes up somewhere around 7150. Where are we going? When are we going to get there? Are we going to bounce around? We're at 6,800 already. So that's about a 300-point rally, less than 5%, 3 or 4% higher than where we are today. And if we do get that rally and we get that completed by the end of the year, then we have to really pay attention to January. First week of January goes the rest of January, and the way of January goes the rest of the year. So we have to really watch. If we hit these targets and get a fifth wave target right here, that completed, after that we could see a pullback, and something to watch very, very carefully. Weekly charts have already completed a fifth wave. As I said, it takes a few weeks for us to complete this. We could see a slightly higher high, and that would move the fifth wave from here to here, but still a completion of that. Same picture, we've completed wave 3 right here in the NASDAQ. Wave 4 projects to the upside, somewhere around 25K, but that is only about 2,000. That is about 2,000 points, less than 2,000 points higher than where we are today. We are at 23,275 today on the close. So I think we have a little bit more on the upside before technically we're satisfied with the market, and then we'll have to wait and see what the fundamentals look like and where we go from there. Looking at the 10-year note, still stuck, the 10-year yield, really between about 4%, which is here, and 4.5%, which is about here. So we've just gone back and forth, up and down. We got higher there, then we came down last week here. Today we're back up above the close to 4.10 or 4.10. We closed at 4.096 today. Gold looks like, again, it completed the wave 3. Wave 4 is here, completed that. Now we start wave 5, which should take us on the ETF to about 410 or maybe even 420, a little bit higher. High yield made this bottom right here, made this bottom right here. We've got a triple bottom. As long as we can hold up here, we're good. Now we need to get above here and complete the fifth wave to the upside in the high yield bond. So everything in the short term looks very good for the next month. Everybody expects a Santa Claus rally. We'll have to wait and see how much we can get more out of this market in December and January. That's the way I'm looking at these markets. Again, if you want to subscribe to this channel, click on subscribe. Every time I post an update, you will get notified. Also, if you want help with your portfolio, want to do a check of where you are at the end of the year, send us an email at invest@compact.com or give us a call at 800-388-9700. Those are my thoughts. Those are my observations for this week. Again, if you want a detailed understanding of all of this that I just talked about, go to compact.com, click on Insights, and listen to the podcast. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.